This video is to be used for educational purposes only and is not intended to replace individual research or licensed investment advice. Unique experiences and past performance does not guarantee future results. Trading stocks, options, and spot currencies involves substantial risk, and there's always the potential for loss. Your trading results may vary. No representations are being made that any software or training will guarantee profits or not result in losses from trading. This is the Premier Trade Forex Report with Scott Norse.
Good afternoon, traders. I'm Scott Norse here with your Forex Report. Today is Friday, June 27th, 2008. The dollar had a difficult week, thanks largely in part to the Federal Reserve. The greenback was holding up fine in the first couple days of trading, with little economic data to influence the currency lower. Oil and gold were back and forth, allowing currencies to trade on their own volition. The biggest event that traders were waiting for was the Wednesday rate decision from the FOMC. We were not all that excited about the meeting itself, except that the rate hike expectations seemed too high for the next few months. This left the dollar in a compromising position, as any misstep from the Fed threatened to cause a sell-off. No rate hike was expected any earlier than August, so we were certain the real excitement would surround the comments. The statement was not dovish at all. In fact, the Fed made several hawkish comments, and one member voted for a hike. However, the Fed failed to signal any intention of raising rates at its next meeting and sounded more like members were crossing their fingers in hopes that inflation would ebb. It took traders only a few minutes to realize the Fed was trying to back away from the rate hike table, and the greenback began to drop. Technically, the charts have really remained open to a push in either direction for the dollar. Most pairs are in some type of range or channel with limited bias. Therefore, the Fed's comments really delivered a crushing blow. Currencies such as the euro and pound used the new development to run through major moving averages, such as the 50 and 100 day. Other currencies were not shy about making a run on the news either, with the Aussie now trading above 96 again. This tilts the long-term picture back toward a declining dollar and puts a new record low within reach. Looks like we're going to close at or near the worst levels of the week for the buck in most pairs. If selling pressure hits early on next week, it's possible that new lows will be made. We will keep an eye on oil and gold, as well as rising commodity prices will only fuel the fire that investors are throwing the dollar into. Now to the big picture. Risk aversion is back on the Forex scene after taking quite a long break. If we look back to 2007 at Dow Jones and Euro-Yen charts, they're disturbingly similar. When the subprime debacle was fully exposed last August, stocks took a nosedive and carry trades followed suit. We then saw both stocks and yen cross pairs rebound and form channels. However, more recently we have seen stocks plunge again, while pairs like the euro-yen surge to new highs. While we couldn't expect a strong correlation to last forever, we certainly did not expect the two to develop an inverse relationship. We believe that may be coming to an end. The yen crosses, known generally as carry trades, have fallen quite a bit in the last 48 hours as the health of the global economy comes into question again. We cannot seem to make our way out of the woods, and some experts believe there's a bumpy road ahead for the U.S. and most other economies. This may cause the risk aversion that has swept equity markets to again take a toll on the carry trades. Some of these pairs are at multi-year or all-time highs and ripe for a reversal. Till next week, have a wonderful weekend. Take care.